The Personal Finance Executive Summary, January 8th, 2014. Welcome to Personal Finance. 2014 themes: growth and shareholder return. With this issue, Personal Finance enters its 41st year of publication, a feat few investment advisories can match. We plan to continue that record of success by helping you to both make money and protect your profits. Currently, we expect the economy to grow about 3% in 2014. The unemployment rate should drop below 7%, and wage growth is picking up. So are various manufacturing indexes. Global growth overall also is expected to improve, and most commodity indexes are off their lows. We expect more volatility this year, but come what may, we'll be here to guide you. We suggest focusing new investments primarily in 3 areas. Number 1, shareholder return. Many of the stocks in the Personal Finance Growth portfolio continue to benefit from rising company revenues, cash flow, and profits plus dividend increases and/or share buybacks. Number 2, stronger U.S. growth and rising interest rates. Think banks, which should benefit from an increased loan demand and better loan profitability. Number 3, improving global growth. Developed market equities generally should benefit from improving growth, more gains in financial stability, particularly in Europe, and continued easy money, led by Japan. We hope this will help the export-oriented emerging markets.
Throughout 2013, Personal Finance has steadfastly bucked the gloom and doom crowd and asserted that economic growth would not only remain on track, but also accelerate. The blockbuster results of 2 recent reports have vindicated our positive view. U.S. monthly housing starts surged by 22.7% in November, driving the annualized level of starts to its strongest reading since February 2008. What's more, U.S. gross domestic product grew at an unexpectedly robust 4.1% annual pace in the third quarter. This rate of GDP growth was the strongest advance in almost 2 years, and only the third time the economy had grown that fast on a sequential basis since 2006. Construction activity also picked up in November as consumers felt wealthier and housing starts spiked higher. And aided by this quickening growth, the U.S. unemployment rate in November fell to 7% from 7.8% a year earlier. Rest assured, we're not blinded by Pollyannish overconfidence. Clouds on the horizon include lackluster corporate earnings and sluggish job growth. But as the new year unfolds, it's increasingly apparent that a solid foundation is in place for continued gains in the market. The duration of this bull market, nearly 5 years, calls for wariness and caution. But if you had heeded the advice of the pessimists in 2013, you'd have missed out on substantial gains. The S&P 500 generated a total return of 30.2% in 2013, the best performance since 1991, when the index returned 30.5%. The upshot? We expect the markets to maintain their momentum in the foreseeable future as the global economic recovery gathers steam. Over the coming year, you can count on Personal Finance to continue pinpointing the best growth investments without undue risk. Our number 1 job is not only to make you a wealthier investor, but a wiser one as well. I'm John Prasinos, Editorial Director of Personal Finance and its parent website, Investing Daily, wishing you a happy and prosperous 2014.
And now for our feature article. Technology grows up. Forget preconceptions that the tech sector is too volatile. We examine tech stocks that have evolved into steady growth and income plays. And with this, Investing Daily is pleased to announce its newest investment service, Smart Tech Investor. Using a proprietary rating system developed by Jim Pierce, the analyst, and Leo Bogle, the strategist, it provides specific investment advice on the large-cap tech stocks that will shape the future of technology. These companies are the utility stocks of the future, and now is the time to add them to your portfolio, while valuations are attractive. Here's analyst Jim Pierce to tell you more.
In January of 2013, I began a 4-part interview series with Leo regarding his interpretation of how he values technology stocks and a proprietary model that he developed over his 20-year career with a major technology company to value technology stocks. Over the course of that interview series, it occurred to me that this would have tremendous value to our readers. What Leo has done is developed a concept he calls integration. Integration is a combination of the words innovation and integration. And what it means is the only way a company can continue to develop market-leading products in the technology sector is by combining their own internal R&D capabilities with external resources that it acquires to create a product that contains all of the ingredients that consumers want. In order to determine the extent to which a company is properly integrating, we've developed two formulas. One we call the Bokel integration quotient, and that measures the extent to which a company is able to integrate. And then we adjust that score with something we call the Smart Tech rating, and that determines to what extent a company is either over or undervalued in the stock market right now. By taking companies with high BIQ scores, but trading at low valuations, you get the perfect scenario, a company that's going to be producing a market-leading product, but the price of their stock doesn't reflect that yet. That's how you make money in the stock market.
Please click the link next to this video. Thank you so much for watching, and join us next time for the executive summary of personal finance.